You only need more capital if you're trading more instruments. Because of the way I do my trading, and the way I think anyone should, to be honest, I actually do this kind of. I look at all these different models within each instrument first. So I'm combining. I'm coming up with forecasts. I call them forecasts. It's basically just the number that outputs from the model. And then I basically, so I'm going to have, let's say I'm trading everything. So I might have probably altogether, if you of the number of different rules and the number of variations together, you're looking at something like, I think it's about 80 to 100 different, permutations. Right. Say. I then take a weighted average across all of those, and I come up with a single number, and I use that then to have my to work out what my position is going to be in, say, the S&P or in gold or whatever.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
Okay, Rob Carver, great to have you on the show. Thanks for coming.
No problem. Thanks very much for having me on.
Really appreciate it. Hey, so today, Rob, I'm thinking my approach is going to be one tailored to myself. So somebody who knows the futures space more or less, but when we actually get into the nitty gritty of building strategies ourselves, a lot of the bugs come out of the woodwork. So it's good to have someone like yourself to kind of work through some of the nuances of futures. And right off the bat, I thought, I could get you to just give us a quick, what you have done and what you are doing, very sort of high level background, because I want you to tell us about the books and the blog, because I think they really frame the discussion. And as I was just saying to you, I've been sort of speed reading your latest book, Advanced Futures Trading Strategies, and I will go back over that in much detail. I think it's just a fantastic way to cover the whole ground and to go from beginning to advanced. And I love the way it sort of works systematically, building your knowledge as you go. Absolutely, 5-star recommendation to go and just get that. And in fact, you're better off getting that book than watching this show, but because you're going to learn it all. I couldn't
possibly comment.
But let's give people a teaser, and then I want to ask you, about what you do personally as well, and getting us sort of newbies started, if you like. But can you give us, Rob, a bit of a background on where you've come from, just really high level, because I know it's all over the internet, and tell us about your blog and your books, because there's just a lot there, and it's a bit daunting.
Yeah, so in terms of my personal background, I mean, I traded my first futures contract in 2002, which seems like a long time ago now. I guess it was. That was when I started my first job in finance, which was working as a trader for a big investment bank, trading fixed income futures and exotic options. I'd done a bit of trading before that, sort of personal share trading, but that was my first kind of real job. And then I moved subsequently into hedge fund space, and I worked for AHL, which is a big systematic futures trading fund. So we're talking about multiple billions of dollars. Mm-hmm. And I did a couple of jobs for them. The first was to build a completely new strategy, which was a systematic global macro strategy. So if you've heard of guys like, these guys like George Soros, who make these kind of big kind of macro bets on the direction of things like, interest rates and currencies. So we were trying to build a sort of systematic model of that, which is a bit different from AHL's core business. Mm-hmm. I did that for a few years, and then I basically got promoted to manage the sort of fixed income team. Fixed income was about 40% of the risk of the portfolio, so that was quite a big job. Did that for a few more years. And then just over 10 years ago now, I decided to spend less time working with other people and doing the kinds of things that you end up doing if you're in a kind of big corporate job. So having lots of meetings and speaking to clients, and I wasn't doing as much of the things I enjoyed, like just doing research into markets. So I decided to give it up and just basically trade my own money. And I've also found time to do other things as well. So I've written 4 books on trading and investment systematically. And the last one I think we'll talk about the most today, but there's they're all out there to have a look at. I also on my blog I have a kind of a loose rule of writing something every month. Sometimes that rule is broken for quite long periods of time because I have too much on. But for the last few months, I've been writing something every month, and that's kind of just around different areas related to quantitative finance and my particular interest in things like portfolio optimization and say futures trading. So, for example, I quite recently did a blog article about whether there's any sort of statistically significant difference in performance between more liquid and less liquid futures, because that's one of those kind of stories that people tell, that less liquid futures have better trend following performance. I didn't find that to be the case when I did the analysis. So I like picking at these little stories that people tell and see if there's really real evidence in them.
Yeah, nice. And how long's the blog been going? Because there's a lot of content on there.
Yeah, it's been going since 2014. So I think my very first article, I think, was basically if you're going to start trading on your own systematically, what kind of sort of hardware and software do you need? And this is what I'm going to use. So it was almost literally from the start of my journey.
Is that article still up there? It must be quite dated.
Yeah. I mean, it's all still up there. Everything's still on there. So that's why there's so much of it, because I never delete anything.
Yeah, awesome. No, it's a huge help. I mean, there's an awful lot on there. In fact, that makes me think that in reading that latest book of yours, you mentioned in the book that a few things are published on the website for the book, but I couldn't find that. Where?
Okay. Yeah. So if you on about page 5 of the book, there's a link to a specific web page you have to go onto.
Right.
And you have to get that from the book because it's behind a sort of a paywall effectively. So it's reserved for people who've actually paid money for the book. Otherwise, it would be a bit unfair on the people who have paid money, because somebody else could just go and search it for free. So it's not straightforward to just go onto my website and find it.
Yes. I was just Googling it in a hurry going, where's this website?
Yeah.
Okay.
I think it's like page 5 of the book. It's quite early on.
Got it. All right. Well, that's handy because you put some interesting notes up there. Rob, I'd love to just start with your portfolio and your trading. So something really practical, and just dive straight into the deep end, I guess. In your own personal trading, it appears that you've got quite a few. So I'm not sure. So quite a few strategies spread across quite a few themes, and then even variations of those strategies. And then I'm not sure on the size of how many markets you're looking at. And I think there's some interesting stuff going on there of late with you. So can you talk us through those 2 themes in your portfolio?
Yeah, what I think I'll do, if I'll sort of take a kind of top-down view and work down into the buckets, because that's the way I find it easiest to think about it. So from a very top-down view, I basically have 3 portfolios, big portfolios. One of those, which is the one I guess we'll talk about most today, is a futures trading portfolio. One of those is a portfolio containing just ETFs. So that's sort of kind of a more traditional long-only. You've heard of this phrase 60-40.
Mm-hmm.
It's not 60-40, but it's of that kind of theme. So it's allocating to both equities and bonds, but only at an index level, and a few other, random funds as well.
Mm-hmm.
And then I have a portfolio of individual shares, which for various reasons is just in the UK.
Okay. Let's stay there for a little bit, just so that we can get the allocations then. So the classic question, of course, is, well, what percentage of your portfolio is in the futures side?
Yeah. So I used to publish this number quite publicly, and actually no, I didn't. So yeah, actually I can be honest. Let me. I need to do the maths in my head because it's not on my track. So it's somewhere around, on a risk basis. So not a cash basis, on a risk basis, it's probably somewhere around 25% of my overall portfolio. So it's I would like it to be higher, and in fact, last year I increased it.
Mm-hmm.
but one of the reasons I can't is to do with the restrictions on what kinds of so I have money in this is quite tedious, but this is sort of detail that people have to
Sure.
think about.
Yeah.
I've got money in both tax exempt and non-tax exempt accounts, and I can't use my tax exempt accounts to trade futures in the UK.
Yeah.
So that limits the amount of money I can put into futures trading.
Understood. And the ETFs, I mean, could we umbrella term that with the term sort of an all-weather portfolio? Is that something akin to what
Yeah,
you're trying to do?
it's kind of So if my second book, Smart Portfolios, is about constructing a sort of all-weather type portfolios of ETFs and saying, well, you want to be in a situation you've got a good diversification across asset classes, you've got a good diversification across countries. Because if you, for example, buy just say you do what is apparently a smart thing, which is just buy a global equity tracking fund. 70% of that is in the US. And like 30% of it's in like 7 companies.
Yeah.
I'm exaggerating slightly, but
Yeah,
it's a big chunk of in the index. And of course, what we saw yesterday in the markets is that those companies just completely tanked.
Yes.
So although they've done very well over the last few years, by just buying a global equity fund, you've got systematic exposure to probably quite a small number of companies. So my work, a lot of my work is in building an ETF portfolio, is trying to do so and still have these cheap ETFs, these really nice cheap ETFs, but trying to steer away as much as possible from just ending up with a massive allocation to just a few US companies.
Do you still apply perhaps a trend following strategy to that, or are you rotating on a sort of a monthly, annual basis, or how are you managing that?
So I trade my UK stock and my ETF portfolios manually rather than automatically. So that means that the trading I'm doing has to be a lot simpler. So and it also means that the frequency is a lot slower. So yeah, I am literally looking at the ETF portfolio. I'm probably looking at it every 3 months maybe, and those are small tweaks. I'm making that it's quite a slow moving portfolio.
How many
the UK? Sorry, go on.
How many ETFs are in there, if I may ask?
I'm going to say about 20. I used to have a lot more, but I've tried to rationalize it down, and I think it's probably about 20 now.
Yeah,
but it could be 25. I'm not sure of the exact number.
Sure. And so that leaves stocks. Again, Are you focusing on trend following strategies? Not necessarily. Yeah.
So the way I trade stocks is a kind of mixture of sort of traditional, what you might call a value strategy and a momentum strategy. So what I actually do is I have a filter for stocks, and I basically rank all the stocks that I in my universe, which is in the UK, is the top 350 stocks by market cap, so most liquid UK stocks. And I use the classic things like dividend yields, forward earnings predictions, book value, this kind of stuff. I calculate a score using a fairly simple formula, and then I want to be buying the stocks that have the best score, but keeping a kind of sector diversification. So if like all the best stocks are banks, I wouldn't just buy like 25 banks. I'd buy like one bank, and then in the next sector buy the next cheapest stock. And then the momentum kind of comes in because effectively on that portfolio, because again, it's not something I'm watching every day or trading automatically. So I actually have stop losses in that portfolio. And so I just set the stop loss. And then, of course, what that means in practice is if the momentum turns against that stock, I will actually get out of the position. So I don't buy on momentum coming in, but a stop loss means effectively that you sell on momentum going out.
That's very focused on UK shares?
Yes, yeah, it is. Yeah, and that's purely because this partly because it makes the tax again less complicated, and partly because the stock screening I use has just got UK data, and for most of the time I've been investing, UK stocks have looked a lot more attractive on a value basis than US stocks anyway, so there wouldn't be a lot of benefit necessarily to. So my exposure to the US I just get purely through ETFs essentially.
Do you still acquire historic data for those stocks and run some back tests on them, or you're?
Yeah, no. I mean, this is the thing. So my stock UK stock trading is basically these kinds of valuation metrics. I know they work. because there's the literature and other, all the big hedge funds use more complex variations of them. So there's not really a lot of value in backtesting. It would involve a lot of additional work because I don't have a backtester or indeed stock data. So I need to do a lot of extra work, and it's not really for me worth doing because I don't feel the need to kind of finally optimize and finally calibrate that part of my portfolio.
Yeah. Well, I was hoping you would know a UK data provider that had survivorship bias-free data so that I could look at that. It's not in my current data provider's wheelhouse, although I think that might be changing.
Well, I'm actually I've literally started yesterday writing my 5th book.
Great.
So, and one of the things I'll be doing that is backtesting stock trading across a few different countries, one of which will be the UK. So I might be able to answer that question for you soon myself.
All
hopefully.
Right, good. What's the new book going to be about?
So it's going to be about. So a lot of my books have been about trading with leverage. So futures obviously are an asset you trade with leverage. I wrote a whole book called Leverage Trading, which is about trading not just futures but other assets you can trade with leverage. That's great, but trading with leverage isn't something I advise most people who are relatively inexperienced to do because obviously it's innately dangerous. So I wanted to write a book that was aimed at a more kind of a wider audience and for trading assets without leverage. So that would be things again like single stocks, ETFs, but also, and may God forgive me for saying this, cryptocurrency, which I'm not. I know I'm not a big fan of, but I kind of take the attitude that people are probably going to trade cryptocurrency even if I tell them not to. So I feel like if they're going to do it, at least they should do it in the safest way possible. So that's what I'm trying to do there. So it's sort of the theme of the book is kind of, okay, I've written these long, quite long books, as you said, pointed out. My last book was very long indeed, full of lots of complicated stuff. I want to try and strip it down to the absolute minimum that someone who's relatively experienced with trading would need to know to be able to trade in a kind of relatively safe fashion. So I'm going to try to strip my kind of quite big and complicated approach down to the minimum number of rules possible. So that's what I'm going to try and do.
Fantastic. On the crypto front, I'm all for trading crypto. In fact, I wonder where you sit with this as well. I find that the biggest frustration that I have with crypto is not crypto; it's the guys and gals that have been trading crypto for 5 minutes and are market gurus and geniuses and seem to know everything about trading in about 5 minutes.
Yeah.
I find that.
Yeah, I mean that's always been a problem in all trading, right? It's just that over the last few years, so if you go back 10, 15 years, those people would have been touting like penny stocks, right, or something like that, or maybe sort of spread bets or forex trading 10 years ago. Now they've moved on to crypto, so the people stay the same. It's just that the whatever so maybe in a couple of years they'll be telling us about the best way of trading with AI or something like that. Who knows?
Yeah. All right. So it was good to get that overview because I wanted to ask about that anyway, your global portfolio. But obviously for this conversation, we want to focus in on the futures side of that. And so in that futures world, then. Tell me about how many markets you trade, and have I understood correctly that in recent times you're looking at a process maybe of surveying a wider selection of assets than you might actually put a position on, but they're all in your watch list. I'd love to hear about that.
Yeah, so if you go back to when I started doing this 10, 11 years ago, I was trading something like 30 to 35 markets. And the reason, and you can contrast that with where I used to work, where I was trading maybe 300, or the business as a whole was trading 300, 350, and that's excluding single stocks and options. That's just in sort of futures and forward FX, and a few other interesting things. So they were probably trading 250 futures markets, and I was trading 30. Well, why is that? Well, it's the difference between stepping down from a $30 billion fund to a fund that's without going into details,
smaller.
is a little smaller than that. So 30 to 35 futures was the most I could manage. And in some of those futures, I was only able to trade a single contract because, of course, unlike in stocks where, well, some stocks are worth $300, $350 perhaps, but you can buy fractional shares at many brokers anyway, so even that problem goes away. But if you look at something like I don't know, I was talking about the Japanese 10-year government bond contract, which has a notional value of like $1 million. So that obviously you don't need $1 million to buy it, but you are going to need enough margin to support that position, and that might be your only position then. So that, unless your account is in the tens of millions of dollars. So to get kind of good diversification across, lots of different asset classes, you can't really, be trading the Japanese government bond. So that reduces the assets you can trade. But even then, you still run into this limitation of contract size. And even with a fair amount of sort of simple tweaking, the best I could manage was about 30 to 35 futures.
Okay.
I did actually write an automated process, which I talk about in my blog, but also in my book, a way of actually sort of calculating, given a certain amount of capital and some inputs, some data inputs, what is the best set of futures to trade that will give you the maximum amount of diversification given the limited amount of capital that you've got. So that's actually something that is in the book.
I'm going to come back to that. That's something I really want to drill
I call that. Yeah, so I call that static allocation because you say up front, I'm going to trade 35 futures contracts, and these are the futures contracts I'm going to trade, and you can't really change your mind. Maybe every year or so you review them and you think, well, actually, there's some better options now, and you should do that anyway, because there's always new futures coming to the universe. Maybe liquidity changes and things like that, and I have a whole process for that review process.
Yeah.
But generally speaking, you can't sort of change the that set of contracts. And then about 4 years ago, I kind of got quite frustrated with this because, they do say that diversification is the only free lunch in finance. I think that Eugene Farmer said that originally. And it really is true that the effects of diversification are so powerful. So one of the things I do in my book is say, well, here's a simple trend following system. On average, if you trade as a single market, you'd expect to have a certain amount of performance. If you diversify that to 100 markets, then the performance increases four or five-fold. Now, there is almost nothing in finance that will give you a 4 or 5-fold improvement.
Yeah.
That is, it's just astonishing. And the thing is, you can do that without being a better trader. You don't need to become better at trading. You just need to trade more things, which, if you're trading systematically like I am, is just a question of, adding some extra data to your database, adding another entry in a data, a list of markets, and then just pressing a button. It's a bit more complicated than that, but it's a relatively easy thing to do. So again, I became quite frustrated with the fact that I could only trade these 30 to 35 markets. So I played around with a few different kind of ideas from sort of theoretical finance, and I came up with this idea that's related to essentially to sort of portfolio optimization tracking, portfolio tracking. So the way this works is essentially every day I pretend that I can trade about 250 markets, something like that. I can't remember the exact number because, for example, I collect, say, let's say the Chinese US dollar FX rate. I think I collect about 3 or 4 different prices for that from different exchanges around the world where it trades. I collect, say, both the price for both the micro and the mini S&P 500 contract. And I do that because, as I said, if patterns of liquidity change, I might want to switch to trading a different one of those things. But before I do this exercise, I take those duplicate markets out. So now I've got, say, 250 markets. Obviously, I can't trade 250 markets, but I basically have a hypothetical set of positions that I would trade if I could trade fractional contracts. So at this point, my positions are going to look like things like 0.001 Japanese government bond contracts. Most of the numbers are going to be less than 1. The most going to be fractions. Then what I do is I say, well, actually, given that I can only trade a whole unit of contracts, what is the best portfolio I can hold that most closely matches that portfolio there?
That's a great approach.
So I'm looking for what I'm looking for is the smallest difference in risk, essentially, between those two portfolios. And I have to be completely upfront and honest. I played around with a few different ideas, and none of them worked. This idea that did work, somebody else actually came up with. It's a guy that literally emailed me when I was going on Twitter and moaning about this. He said, "Hey, why don't you try this idea?" And I tried, and it worked. And he's credited. I can't remember his name off the top of my head, but he's credited in the book and he's credited in my blog. But anyway, so he came up with this idea, and I tried it, and it with some changes of my own and some tweaks, it works really well. And that's described again in the book and also on my blog as well. So, and I call that dynamic optimization, because rather than a static set of contracts, you're effectively trading you might be trading a different set of futures markets every day. That most closely matches the portfolio that you really want to have, but you can't afford to because you haven't got $100 million.
So there is that element that you could be. So once you're long a position, you're in a particular market, this process could actually cause you to knock that out and replace it with something else, or once you're in, you stay in.
So there is included in that calculation is a cost calculation. So what it's saying is, what's the best portfolio we can have with two constraints? Firstly, we want to have something that matches the portfolio that we want to have most closely, but also we don't want to spend too much money in trading costs. So the other thing we've got to do is look at the positions we had yesterday, and then say, well, we're not necessarily going to change all of them. We might just make one, do a small number of trades. And actually, if I look at my trading, unless the market's moved a lot, I'm normally only doing about 3 or 4 trades a day. So most of my positions are remaining. So I still have about 30 positions on, as I did 10 years ago, but it's those 30 positions are drawn from a much bigger pool of contracts. And those positions won't be changing radically every day, partly because my trading system's not a particularly quick trading system. But rolling brings some complexity into that, but we can talk about that later. But what it will be doing is things like, let's say you want to be long Japanese 10-year government bonds. Well, it might be like, well, hang on a second, you can't do that because they're just the contract size too big. What I'm going to do is replace that with, say, a Korean 10-year bond, which I also trade, which has a much smaller contract size. But has a very high correlation to Japan because, Japanese and Korean interest rates, they're in the same kind of regional part of the global economy. They're going to be quite similar. So it's implicitly doing those kinds of substitutions. It's not explicit. The algorithm doesn't sit down and do that, but that's the kind of behavior that you'll see in it. And you can then, what I then do is I can run diagnostics on it and check. Like, for example, if the original big portfolio was long equities, is this new portfolio also long equities? Because it should be. It should have the same kind of rough exposure to different assets.
Okay, well, you've complicated it for me because that
it's not what I normally try and do, but I apologize for that.
Makes the traditional questions a little more null and void, but maybe we can sort of ballpark answer them as well to come at it from a different angle. I guess I like to know a little like what you just said there. I like to know what the best that could be achieved is. Like, there's no point saying I've only got 10 grand. What can I do in the futures market? It's like, well, it's just not enough. So you might. So then for me, the mental journey goes, okay, well, like, what? Just tell me the optimal amount. Like, what can I do with tens of millions, so that I know if I only have 1 million or 5 million, just how much disadvantaged I am. I think that's an interesting thought experiment. And so if we're, giving people an idea of, the basics of what kind of, how much capital they would need to trade a well-diversified futures portfolio across multiple contracts and multiple strategies, without applying too many tips and tricks, is there a curve there where we can say, well, look, somewhere between, 100 and 500,000, you can do okay? Do you need at least 1 million? Does it start to get dramatically better after a mil to 5 mil? What would be your thoughts around that?
Yeah, I mean, I've done some work on this. I'm going to struggle to remember the exact numbers. I mean, as a rule of thumb, I say to people, if you've got less than $100,000, I really advise you probably not to trade futures, because I think you're going to struggle to get the. So the big benefit of trade futures is diversification across asset classes. So you can get that to an extent with ETFs, but then there are, you might not be able to use leverage. You might be able to go short. And I'd say that the big advantage you'll be able to diversify across asset classes. If your capital is so small you can't really do that in any meaningful way, then you're better off sticking to to stocks or to another asset class. I would say. So 100,000 for me is the absolute bare minimum. I would not go below that. You can get when you're up to the sort of $500,000 mark, then you're going to be in a position where you probably can have sort of 10, 15 futures contracts and a reasonable amount of diversification across asset classes. And in terms of the theoretical performance, you're kind of giving up from the guy that's got $100 million. You're probably losing about a third of the performance that they could expect. So you're like 2/3 of the way there. So that that's pretty good, I'd say. And then it is literally a kind of a curve that sort of flattens off. So there's diminishing returns to scale. So when you're up to the $10 million, you've probably captured sort of 80 to 90% of the value. And yeah, I would say 30, 40, 50, $100 million is at the point where you're not really worried too much then about losing diversification. You can trade pretty much any future you want, and in enough size. And actually, beyond that, arguably, you could make the argument that potentially you can get too big, right? So that you get to the point where you can't diversify because a lot of the less liquid futures contracts, just the markets just aren't big enough for you to take the position you want to take in them. So if you look at when I was at AHL and my portfolio was the sort of notional client capital allocated to it was about $8 billion. I couldn't take the sort of same size position in a small bond contract like, say, the Korean bond market as I could in the US bond market. So my kind of risk allocation was suboptimal, in the same way that a very small trader who can't trade, say, Japanese government bonds has also got a suboptimal risk allocation. So you can be too big as well as too small.
Yeah. What about the strategies that you're trading at the moment then? And again, just skimming your blog, I wasn't completely clear as to whether you had published all of this in great detail on your blog, but I certainly got the idea that you had a selection of convergent strategies and a selection of divergent strategies, and possibly quite a number of variations or permutations of each of those. So how many sort of models and model variants do you have going on in this portfolio?
Yeah. So again, I think it's helpful to think about this in a sort of top-down way. So if we think about the big split between convergent and divergent, first of all, so divergent is the way I think about it is divergent is you betting on the market changing. So that would be things like momentum strategies. So I have a number of different. I've got sort of in that bucket. I've got sort of three main categories, I think. So I've got what I call momentum. I've also got what I call breakout, and then I've got what I call acceleration. So momentum strategies, I've actually got a number of different ways of measuring momentum. They're all quite correlated, but I like to have diversification across things, even if they're fairly similar. So I do moving average crossovers, which is a very classic way of measuring momentum. And then I do things. I do this thing called normalized momentum, which again I describe in the book, where you take the price series and you normalize it first, and then you measure momentum on it. And then I have what I call asset class momentum, where basically you're not just you basically, rather than say looking at say the S&P 500 individually and saying, is that going up or down, you essentially form an asset class index. You kind of build something that's a bit like your own MSCI World Index. It's not exactly the same because it's not market cap weighted and it's vol adjusted, but you build them an equity kind of price curve, and then you look at the momentum on that, and then if that's long, then all of the equities within that would have the same position on. And so that's the momentum bucket. And then the next divergent bucket would be breakout. So breakout, a lot of people are familiar with it. The idea is that the prices move in a range, and when they get to the edges of that range, then they're broken out and you take a position on. I do something similar to that, but because I don't like this idea of not having a position on until you reach the edge of the range, I actually start building a position when I'm above the middle of the range, and then increase it as I get to the top of the range. So it's quite correlated to momentum, but not 100, it's about 80% correlated because it is doing something a little bit different. And then I've got acceleration, which is just the change in momentum. So basically, if momentum is increasing in pace, then you put a bigger position on, and if it's reducing in pace, you put a smaller position on. That's pretty straightforward. Then I've got my convergent strategy. So they're all assuming that the world's going to remain the same. Things like relative value and mean reversion also fall in this bucket. My kind of main convergent strategy is carry, which looks at the shape of the futures curve. So if the futures curve is sloping upwards, then it's going to go short contracts further out because it assumes they're going to roll down the curve in price, and vice versa. And I do that both on individual markets, but also I look at relative carry. So I look at whether the carry is strong in versus the asset class overall. Which reminds me, I've forgotten about a divergent strategy, which is relative momentum. So I look at momentum versus an asset class as well. I look at mean reversion within an asset class, but over long time periods. So if the S&P has been outperforming other markets the last few years, which it has, I'd go short the S&P versus the FTSE and so on and so forth. I look at skew. So I look at whether markets have had unusually horrible returns recently, because that turns out to be a buy signal. I think that's most of them, but there are so many that, as you can tell, I don't have a clear idea in my head about, and I've even missed some. So what I might do is, while you're talking, is just quickly check to see if I missed any, actually, while you ask me the next question.
And then you actually, so for a given model, let's call it, you could trade a few permutations of that model as well. Is that a fair way of saying it? Yeah.
I call them variations, but if we take something like momentum as a simple example, so if we say a moving average crossover, that is defined by two numbers: the fast moving average and the slow moving average. And so basically, if those numbers are small, then you're going to be trading and looking for relatively fast trends, and if those numbers are big, then you're going to be looking for relatively slow trends. So I trade 6 different variations of the moving average crossover rule to pick up trends from different speeds. So I'm looking for both fast trends and slow trends when I'm doing that.
So this is, ties back to the number of markets you're looking at and the amount of capital that we've got. So if, you've got multiple variants of multiple models, and as you detail in your book, you with futures, obviously you've got a limited amount of granularity if you want to be able to scale up and scale down with some large contract sizes. Then you need to have a fair bit of capital on hand to be able to do all of that.
The answer is no, you don't. So
okay.
You only need more capital if you're trading more instruments. Because of the way I do my trading, and the way I think anyone should, to be honest, I actually do this kind of. I look at all these different models within each instrument first. So I'm combining. I'm coming up with forecasts. I call them forecasts. It's basically just a number that outputs from the model. And then I'm going to have, let's say I'm trading everything. So I might have probably altogether, if you put the number of different rules and the number of variations together, you're looking at something like, I think it's about 80 to 100 different permutations. Right. Say I then take a weighted average across all of those, and I come up with a single number, and I use that then to have my to work out what my position is going to be in, say, the S&P or in gold or whatever. And by doing that, if the alternative would be to work out what the position would be in permutation 35 for the S&P, and then trade that individually, and then do the same for permutation 36, and so on and so on and so on. That would mean, yes, I would need to have not just $1 million. I'd need to have that times the number of permutations, $100 million, which would be and there's no value to doing that. You don't get any additional value really from trading those permutations individually. The only value you'd get is it makes it easier to attribute your performance to different permutations. But you can do that in a back test in an approximate way anyway, and that's good enough for me. So yeah, you don't need more permutations. Does not mean more capital. Only more instruments needs more capital.
Okay, so just let me ask a question about that. So let's say we've got permutations such that does it mean that we could be creeping into a position incrementally over 7 days then, let's say, and then if we're doing that and we can't buy fractions of the futures contract, and we could end up still increasing that position over time, we'd still need to be able to take 7 contracts on board. Am I thinking about that right?
So one of the advantages of trading this way is it completely separates out the issue of things like the number of contracts, the amount of capital you need from how many permutations you're trading, because you could be trading one permutation or you could be trading 1 million permutations. Ultimately, averaged out, they all come down to a single number, which we then use to take our position size. And the more capital we have, the more instruments we'll be able to trade, and also the more granular that position size can become. So, I'm trading perhaps maybe 2, 3, 4, or perhaps 5, say, I don't know, US 2-year bond futures. When I was at AHL, we'd be trading thousands of US 2-year bond futures. So we'd have more. We'd be able, So if our kind of the final number we're looking at kept moved from 30.1 to 30.2, we'd be able to actually trade. That would result in us trading perhaps 50 contracts. Whereas, in my world, that movement has no effect whatsoever on my position.
Yeah, okay.
Because it's just a tiny fraction. But that's completely separate from where that number comes from and where that change comes from. What it does mean, however, is in my world, then if I add a permutation to my model that has, say, a 1% weight, it's going to have a very, very small effect on my performance. Very, very, very small. It may even have no effect on my performance at all. I might not just see any difference at all, because it might only be on 1 or 2 days of my back test when that actually changes the number of contracts I'm holding. At AHL, where I used to work, and I had much bigger positions, that 1% new permutation, I would actually see it changing my there'd be a few contracts difference in my position every day, and at the end, and I would be able to see at the end of the back test a difference in performance. Now that difference in performance would be very, very small because it's only 1% of my weight, but it would be there. So you could argue that the one consequence of this is that there's less value in a smaller trader doing lots of research into lots of tiny incremental improvements, because probably it's not going to make a lot of difference at the end of the day.
All right, you mentioned the word forecast there. I want to pick up on that, and I just want to pick up on the continuous trading versus the discrete trading you do. They're 2 themes in the book. So could you tell us a little bit about how you practically implement an example perhaps of what you mean by and how you implement continuous trading?
Yeah, let's use breakout because I think it's conceptually similar for most people to think about. So imagine that prices have been moving in a range, and imagine that yesterday your price was bang in the middle of that range. That the way I define breakout, that means that your forecast would be 0, so you'd have no position on. We're going to ignore anything to do with dynamic optimization. We're going to ignore anything to do with costs. So we're basically assuming that everything goes straight through to the final position, because that just simplifies things. Now let's imagine today that the price ticks up within that range. So now it's gone from being in the middle of the range to being say there's been quite a big jump. It's gone to being halfway between the mid price and the maximum price in the range. So the way I define my forecasts, I would say that's a forecast of plus 10. plus means it's a long, it's a bullish signal. 10 is my kind of sort of average number. So 10 means it's the average size position. Smaller than 10 means I'm less bullish. Bigger than 10 means I'm more bullish. And the different ways of forecasting have different ways of translating the change in price or whatever into that number, but that doesn't matter. Ultimately, you come up with a number, the average of which is 10. And I also cap that number at 20. So anything bigger than 20, I don't actually go any higher than that to limit my sort of exposure to a single instrument's risk. So yesterday we had no position on. Now we have plus 10 on. So what we're going to do is we're going to, that would then be translated into a position, and that might be something like buying like 2 contracts or 3 contracts. And then let's say that the day after things get even more bullish, and the price moves to the top of the range. Well, for me, that would be a forecast of plus 20. So the following day, I would actually double my position and actually buy another 2 or 3 contracts on top of that. So now I've got 6 contracts. And then so that's an example, a very similar example of continuous trading. Now, that's not how most people trade. Most people would trade using what I would call a binary or discrete trading. So what they would do is, assuming they're using the same kind of system that I am, they've got no position on. They wake up, and the price has moved above the zero bound. Well, now they're like, oh, I'm bullish now. There's no kind of quantification of that. They're just like, oh, I was flat, now I'm bullish. I'm bullish. So now I'm bullish, I'm gonna buy. And they would then buy a certain amount of contracts depending on the way their system works. And that could be the same number of contracts I bought. It could be 3, it could be 4, it could be 5. And they own that position now. The following day, the price has gone up. They're still bullish. Nothing's changed. So that, they're still holding the position. Now, the following day, let's suppose the price starts to fall again. Well, I'm going to reduce my position because the forecast has gone from 20 to 10. And then if it keeps falling, I'll reduce my position again until I'm flat, and then I may even go bearish. The other person, well, they're going to probably have a stop loss in place, which means that they'll, at some point they'll close that position entirely. So they go from being zero flat to being bullish to being flat again. There's no quantification there. So what continuous forecasting does is it allows you to have a much more nuanced view of whether you should be long or short the market. And if you think about all these permutations I'm trading, that means they are actually going to feed through into my opinion on what position is. And the other thing it does is it essentially provides a natural stop loss. So if you're assuming you're trading some kind of momentum type system, which breakout is, then I don't need a stop loss because so I talked about stop losses earlier in my equities portfolio. I don't use them in my futures portfolio because if the price starts to move against me, my forecast is automatically going to start to reverse and then go to zero, and I'll close my position automatically. But that closing position is a very gradual thing, in the same way that the opening position is very gradual rather than a sudden stop.
Just fill the gap for me. How do you get flat in a continuous system? How long can you be flat for?
So to be very pedantic, if I had infinite amount of capital, I'd never be flat, right. Probably, because that would mean my forecast would have to be exactly zero. Yeah. Mathematically, that's very unlikely. But because I'm unless I haven't got infinite capital, so I'm in a position where I'm only buying a few contracts. In practice, once the forecast falls below a certain number and gets quite close to zero, and it's essentially rounds to zero, at that point I'm flat. Okay. So I'd be flat quite a lot of the time probably. The more capital you have, the less likely you are to be exactly flat.
Excuse me. So the concept of your forecast is closely tied to the concept of the continuous trading.
Yes, because if you can trade discretely with a forecast, because basically you just say is the forecast positive or negative.
Sure.
Or you could do something like say, well, I'm not going to take a position on until the forecast is at least 5 or 10, and then I'll go long, and vice versa on the short side. That's the other way of doing it. But you can't trade continuously without a forecast because obviously there's no number coming into that.
So just explain the forecast for us, the concept.
So a forecast is just a quantification of how strong a particular signal is, where a signal could be something like breakout or carry or momentum. And as I said, for me, the quantification is 0 is flat, 10 is sort of averagely long, -10 is averagely short, and then I won't go above twice that, so I don't go above plus 20. So if 10 translates into a position of being long 5 contracts, I would never be longer than 10 contracts or shorter than -10 contracts.
I want to drill into two of these strategies quickly, if I could, and then let's move on. But the mean reversion and the sort of relative momentum. So relative momentum is obviously something stock traders are quite familiar with. Maybe futures traders are as well, but I'm not so much. So what are you measuring? Like, are you measuring things generally relative to an index or different individual contracts their relative trends to one another in a similar fashion to what happens in the stock market?
I mean, it's analogous to stocks in the sense. So let's think about how stock traders do it, because I think you're right. I think most people are very familiar with that. So if I was a stock trader, I would do something like, say, I'd have my basket, my universe of stocks. I probably, most sort of hedge funds do this on a sector basis. So they do something like take all US tech firms as their basket. So maybe that's out of the S&P, maybe 50 of those stocks are tech stocks. I don't know. And then what they're going to do is compare those stocks momentum to each other. There's a couple of different ways you could do that. One is literally to say, well, you rank them from the highest momentum to the lowest momentum, and then you go long the top 25 and short the top 25. That's a pretty typical way of doing it. Another way of doing it would be to say, well, let's have an index of US tech performance, and indices can be market cap weighted or they can be equally weighted. And then you'd compare the performance of the stocks to that index. And they're not going to necessarily give you exactly the same answer, by the way, because then it's possible that only one stock has beaten the index and the rest haven't. That's perfectly possible to happen if that stock's got a big market cap, for example. Now, the way I do it is more like the second method. So I start off by saying, well, let's, and the way I do it is within asset classes. So I will do, say, all stock index futures in my portfolio, which is, DAX, FTSE 100, S&P, and so on and so forth. And then what I do is I say, well, I'll construct an index out of them. Now, I could just use MSCI World, but I don't like MSCI World because it's, as I discussed at the start of the podcast, it's market cap weighted, so it's a big chunk in the US. So I actually have an equal weighted version of that. And it's actually also volatility adjusted, which doesn't make a big difference in stocks, but does in other asset classes. So I'll end up with essentially something analogous to the stock market example. I'll have an index of global stock market performance, and I will have then the individual markets around that. And then what I'm doing is I'm basically going to, if you imagine a line with, there's a problem with cameras, my mirror's inverted, but hopefully it's right around now. Yes, if you imagine a line of stock going up, and then if I focus on just the S&P 500, that's going to be probably going up higher. If I compare those two lines and look at that line, I'm then looking at the momentum in that line. So that line's going up because the S&P's been outperforming. So I'd belong the S&P in this example. So that's how I do relative momentum. So it's not that dissimilar from stocks. There's just some sort of complications in the fact that I build my own index. It's volatility adjusted, but the principle's the same.
Okay. And what about the mean reversion? And do you do any how would I say it, outright mean reversion? I get that you do various classes of convergent strategies, but just literally buying dips and selling over extended moves, is that something that's applicable to futures?
So it's something that works at relatively short timescales, I think. One of the things I do in the book actually is analyze the performance of momentum at different timescales, and I know, and you can really see a kind of the so-called dead cat bounce effect, where if there's been a really strong down move, the market tends to go up the next kind of couple of days after that. And what that means is that actually a very short time frequencies, the momentum doesn't work very well at extremes because the mean reversion kind of counteracts it. So I have actually experimented with having that kind of model in my portfolio, but because it's quite short and I prefer to trade more slowly, it's not really something that has much of an effect. So I personally stay away from it, but it does, and indeed in the book there is a strategy which I don't actually trade myself, that implements a kind of shorter term mean reversion as well, combined with a trend strategy. That's again, so that's something that in principle will probably work okay, but the way I'm trading, it doesn't really make sense for me to implement that. So yeah, the way I do mean reversion, actually, I can describe it to you very quickly. Is if you take, because I've already described it to you, if you take the relative performance of the S&P and that index over kind of short to medium term time frames, I trade that as a momentum strategy. But then over very slow time frames, and I'm talking like a couple of years plus, I trade that as a mean reversion strategy. So if the S&P has outperformed the index for a long time, I expect that to mean revert. And hey, maybe that's what we saw yesterday starting to happen, right?
Yeah. So for context, it's like that was the 27th, I guess, of 27th.
Yeah, it was the big meltdown in kind of Nvidia and sort of all AI related stocks because of the release of the Chinese DeepSeek model. Yeah.
Did it have much of an impact on you?
I actually checked this morning because there's a few people on one of the forums I post on who are all saying, "Oh, I've lost 5% this much." I lost, I think, 85 basis points, so less than 1%. So I seem to be okay at the moment. Touch wood.
And how was 2024? We've just finished 2024. Rob, did you have a good year?
No. I'm trying to remember the exact amount. I think I was down like a few percent, something like that, off the top of my head.
Yeah,
I can't remember the exact number, but basically, I did very well up till April, and I had a sort of high watermark in my performance. But then I had things went kind of badly and then sideways. So for the year as a whole, I think I was down, but less than 10%. Yeah, so no big deal.
Next 1,000 trades, as they say. It's a long-term game. 2 questions so I don't forget them. Well, no. First question, advantages of this continuous futures trading or continuous trading. Well, what are the advantages?
Well, the first advantage is it does perform better. So if I look at performance measures, it results in a much smoother sort of risk profile, and that translates into higher gains overall. Not so much of an advantage for a smaller trader, but for a bigger trader, it reduces transaction costs because you're not doing, if you can imagine you're a big hedge fund, so you've got to go long, you've got to buy potentially a few hundred contracts, and then you hit the stop loss, you've got to sell them again. That's going to create quite a big footprint in the market and a lot of slippage. And that's why, where I was working before, that's why we use the continuous trading method there. But for me, it still makes sense to use it now because, I definitely see an uplift in performance.
And look, we know you're a positive skew guy. You want to have a positive skewed portfolio. How do you bring in these convergent strategies, mean reversion style strategies, into that framework? Is it just the allocation to them is sufficient that your overall portfolio is still positively skewed?
Exactly that. Yeah. So I limit if I have to look at the theoretical amount of convergent versus divergent stuff I should have in. I probably I'm actually not as positively skewed as a lot of people who are in the industry and are managing other people's money because I can do my own thing to an extent. So I'm prepared to give up more of my positive skew for better performance. But yeah, I limit my divergent stuff's limited to like 40% of my portfolio. So it is going to have a limited impact, and I still end up with a positive skew afterwards, although not as much as I would if I was just a pure momentum trader, obviously.
And I did just quickly want to circle back to the contracts that you select, and I think you've got some novel approaches on your blog and in the book on I guess more systematic ways to select the markets in your portfolio, which I think is really cool.
Yeah.
So how just give us a high level, I guess, on that. How are we selecting? How best to select markets that's not just curve fitting? I always think of the cocoa example at the moment because I struggle to believe that many traders would actually have cocoa in their portfolio and suddenly they have all cocoa in their portfolio.
Yeah.
How do we come up with a non-curve fit, optimal sized universe of an optimally diverse universe? What are some of the principles there?
Yeah, well, so the first thing is to think about the information that's going into that decision. So one of the things that's not going in there is performance, because actually, cocoa is a really bad performer in if you actually looked at the back test for a long time. So as you say, there's no one would have put it in there just for performance reasons. So what you're trying to do is essentially maximize diversification, while also thinking about what I would call expected performance after costs. So what I basically do is I kind of choose a contract initially, and that contract's going to be something that's probably quite cheap to trade, but also not very like a big contract size. So it's going to be something that I know is not going to cause me problems with diversification. And then essentially what I do is I iterate through my big universe of contracts, and I say, well, what out of if I add, which of these contracts should I add next that will improve my diversification by the most? And bearing in mind again the fact that there'll be some effect on costs. So what that's doing essentially is just saying it's got a few pieces of information in it. It's got correlations to calculate diversification.
Mm-hmm.
It's got costs. But it's also got a kind of very simple expectation of how performance degrades when you can't trade as many contracts as you'd like to. So as a rule of thumb, I'd ideally like to be able to trade in such a way that I have at least 4 contracts in a given instrument. That way I can get more of the benefits of a continuous trader. Because if you think about it, if I can only trade one contract, then I'm basically back to being a discrete trader, pretty much.
And
right?
You can't get any smaller a position. If you got 4, you can go to 3, 2, and 1.
Exactly. Yes, I've got a bit more effort there. So I did some research, and I ended up with a very simple kind of curve saying, well, what's the degradation performance when you go from 4 to 3 to 2 to 1? So that with those pieces of information, then in the calculation, then the optimizer can then work out what the best next contract to add is, and then essentially it keeps iterating through that process until it gets to the point where instead of the performance going up when you add a contract, it starts to go down. And that's the point when you've basically maxed out your capital and you can't do any more.
Yeah, it's great to have a systematic approach to that. So there's so many reasons to buy your book, Rob, because it is so well laid out, and it just takes you through the journey actually as you learn more each chapter and how to implement all of this. I think it's really foundational. Your books and Andreas Klenau's books should both be in the Futures Traders Library. I've heard you or I've seen you write about instrument weights as well. So how do you actually weight how much or allocate how much you might trade to particular sectors or classes in your portfolio? And then how does that dovetail with, the fact that you're going to take a risk-based position size, if you like, and that how much you trade in a particular contract, or when you take that trade, the size of the trade is determined by the risk. Is it then also you want to limit your allocation in your whole portfolio to different sectors?
Yeah. I mean, I'm trying to maximize my diversification. So again, I take a top-down approach.
Mm-hmm.
So I'll say, right, I want to allocate. Say I've got 7 different sectors I'm trading. I want to allocate about 14% of my risk to each of those, and then within those, I want to. It's not exactly. There are some. This is an approximation. So I think I do something a bit more complicated than this, but then within that sector, let's say within the bond sector, I want to allocate, between say the US and Europe and the Asia, and then I'll dive into Europe and say, well, I now want to allocate to Germany, the UK, and so on and so forth. And then within Germany, I want to allocate to the different German bond futures, so the Schatz, the Bund, the Bobble, and the Boxall. That's to sort of maximize my diversification, because I don't want to end up in the equity world I keep coming back to, where 70% of the sort of global index is actually in a single country. I'm definitely big on, and that means, for example, that something like cocoa. In my big portfolio, so not the one I'm not the one I actually trade, but in the theoretical big portfolio, will only have a small weight. It'll, and the average instrument in my portfolio is going to have, because I'm trading, say, roughly 200 futures, is going to have a weight of about 0.5%. So any individual contract's not going to have a big weight on the overall performance.
Yeah. So when you take, are the position sizes that you take in a particular sector tempered by that sector limitation, or you would take sort of the same, you'd have the same risk calculation or sizing calculation across all your instruments. It's just that you can max out, and surely not that.
Yeah. So I have a maximum limit on the size of position I'll take in any individual instrument. But yeah, it might be the case that, let's suppose, hypothetically, it could be the case that all of my sectors have got no position on because the forecasts are very close to zero, and it just so happens that I've got a lot of risk on in equities because equities is really going great guns. So that means my average allocation to equities is, say, about 14%, roughly speaking. Well, I could go to twice that, right? As I said earlier, my risk could go to twice my average risk. So my risk in equities might be 28%. So that's a lot of the risk I currently have on, but because all the other risks are zero, actually, although my portfolio is heavily weighted towards equities, my overall kind of risk is only going to be about a third of what it normally is on average. So, I have a lot of exposure to equities, but because that's in a situation where I haven't got much risk on generally. If I look at my but the advantage of trading so many instruments across so many different asset classes, that actually my overall risk expectation on a day-to-day basis is fairly constant. It doesn't actually change that much. It'll change as signals get stronger and weaker, and it'll change as the correlation between different positions changes. But on average, it is fairly stable, and that's a big advantage of diversification.
Okay, so I've kind of covered the first two broad topics that I wanted to cover, perhaps all in a mishmash there. I wanted to talk about your portfolio, and then I wanted to talk about the newer guys getting started with minimum account sizes, minimum amount of diversification that made sense. And the third chapter, if you like, that I wanted to cover was to help people like me, just drilling into some of the complications of futures, things that are going to crop up, things that you're going to have to deal with that are different if you are even a advanced systematic equities trader. The first one on my list is the myriad of different exchanges. So do you sort of cover? Obviously, you cover quite a large range globally of different exchanges that you're trading on. I've noticed already that can mean, like, for example, at the LME, the contracts are different to CME contracts, if I understand correctly. So is it just a matter of almost like trading ETFs, becoming an expert in each and every contract one at a time to make sure that you've got the nuances and each exchange's nuances and how you're going to handle that? It sounds quite time consuming.
It's so you don't need to have a handle on the nuances, because I think that there's a big misconception that, it's a misconception. The way I trade is quite different from the way that a lot of people trade. A lot of people, discretionary traders who want to trade a particular market, are going to need to spend time learning and understanding the way that market behaves. I would imagine. I've never been a discretionary trader, so I don't really know, to be honest. Because I'm trading in principle all markets in exactly the same way. All I need to trade a market is essentially the kind of bare kind of parameters of the market. So things like what the lot size is, what currency does it trade in, what the tick size is, and that I can get automatically from and put into a database, and that's a 5-minute job. And then I need to get some price history and just to sort of warm up my system. I probably need a minimum of a year of price history, I'd say, to start trading something. Get that data, upload it, and put it in database. And then I need to sort of set my system up so it's automatically updating that data every day and then checking for positions on that particular instrument. I might need to do some work in calibrating the weights to different variations of signals. I'll probably roughly calculate what I expect the trading costs to be. although it is only a rough calculation, and I kind of won't know for sure until I actually start trading. So I do all of that, and that's not a massive job. That's probably in total a couple of hours of trade, if that. Because the broker I'm using is very, has got basically allows you to connect to a lot of exchanges pretty much automatically. I don't really need to understand how the exchanges work. The kind of broker abstracts that away from me.
Well, I'll give you another example that comes to mind is, in Australia at the now ASX, used to be SFE, the tick sizes on their interest rate contracts is variable,
I know what you're going
right?
to say. So these
kind of
so
things.
I do not. Okay, that's quite unusual. I can only think of about 3 examples where that happens across the whole world. And as it happens in my system, I do not trade those contracts because of that exact reason. Because that level of complexity would make my entire system way too complicated.
Okay, and the LME, the contracts, they're substantially the same as.
Yeah, so I don't trade directly on the LME because I'm not actually allowed to. That's actually quite hard to do as a retail investor. Right. But the broker I use provides what I'd call the shadow contracts for the LME that allow you to essentially trade the LME contracts without trading the LME contracts. So again, the complexity of the LME is abstracted away from me.
Okay, Rob, we've had a few technical difficulties. We've changed location. You've come down from the Alps, from the little ski hut that you were recording in, as you like to do. I think everything will be all right. We will just sort of press on and wrap this up. So I guess where were we? We were talking about some of the traps for young players, as we like to say with trading futures. So some of the things to be mindful of. You were saying that it wasn't that scary. I'm going to jump into another thing that's come up that I think people need to be mindful of when they're building a futures trading strategy, trend following portfolio. Minimum volatility. So instruments that are not very volatile at all. If we do a risk-based position sizing, we could end up with these enormous positions.
Yeah.
I guess there's a few ways of handling that. How do you prefer to handle that?
A couple of ways. So the first thing is I actually have a minimum level of volatility below which I won't actually trade a particular instrument. So I have a number. I said earlier that you should sort of regularly review the contracts that you're trading for various metrics. So I have a limit on volatility. I also have limits on liquidity and on costs. So if any instruments kind of fall outside of that band, so volatility gets too low, or they get too expensive to trade, or the liquidity falls off too much, then I'll sort of stop trading those in my portfolio.
Okay.
Just to say as well, because of the dynamic optimization, I can still include them in my big portfolio of 150, 200 instruments. It's just that the optimizer knows about these constraints, and it'll say, well, I'm not going to take a position in this market. So let's take a concrete example of, say, US 2-year bond futures. US 2-year bond futures are, I haven't checked recently, but they have certainly at times been below that minimum volatility level, because obviously they're quite a safe instrument. And that means I wouldn't trade them, but I would still calculate a theoretical position for them. And then when it comes to my dynamic optimization, I would probably replace those with 5 or 10-year Treasury bond futures, which are obviously very correlated instead, and where the volatility is higher, and so they sort of pass this filter. I also have some hard limits on actual sort of position sizes. So and basically I don't want to, and that's calculated by saying, well, I don't want to have a sort of big, as a percentage of my capital, I don't want to have a position that's bigger than a certain number of multiples of that.
Okay.
So I wouldn't want to have 5 times my capital notionally in a particular instrument, which looks safe because the volatility is so low, but of course then it exposes you to the risk that that thing could go down by 10%, and you'd lose 10% of your capital in one go if say that was, you know, you're 100% notionally. You don't really want to be exposed to that. That's because that's a sort of a cruder measure. That's kind of what that's dealing with is the problem that I might have an instrument that has an okay volatility, and then the volatility drops. And so the position size would automatically increase, leverage would automatically increase. Because I don't this review process isn't like every day, it's every few months. That sort of protects me from a situation which an instrument becomes a bit too safe, low volatility, and the leverage increases. So that's going to hit a hard stop, and then not go above that level. And then when I then come to review my instruments, that will then probably flag to something I should take out of my portfolio entirely.
Okay.
So those are the two ways that I deal with that problem.
All right, good. Makes sense. Back adjusting. Now, let me ask first, do you use CSI data? And obviously CSI has a number of ways to help us with the back adjustment of contracts and, you know, choosing what we'll do. But what are your preferences for back adjustment and why?
So I actually do my own back adjustment.
Okay.
So I start with the prices of individual futures contracts. I collect those individually, and then I stitch those together into a back adjusted series. And I do that for a couple of reasons. The first reason is for the carry type strategies. I actually do want to see the whole futures curve. So I do actually want to know what the relative prices are. I need that as an input into my system. So if I was getting a single back adjusted price from CSI or anybody else, I'd need to then separately go and get those prices anyway. So, you know, it's just not really helping me in terms of workload. The other issue is it just gives me more control over what's going on. So I then know for sure how the back adjustment was done. And the main reason where that becomes important is I can control the point at which the roll's happening in my history, my price history, because I have different preferences about which contract I trade. So, you know, a lot of the time there's only one contract that's liquid enough anyway, and that's the front contract. But sometimes I'll be in a situation where, for various reasons, I want to trade maybe the second or the third contract. And if I'm just pulling a back adjusted series of somebody else, that will probably be just for the front contract. Some provided for other contracts as well, but it'll probably just be the front contract. So that allows me to fine tune and say exactly where my roll points are in history. And although that doesn't make a big difference, it's quite a second order effect. It does make a little bit of a difference. So it's good to know that I am actually picking up the right contract and I'm doing that back adjustment.
So this is something you've mentioned before. So trading, say, the second or the third month in preference to the first.
Yeah.
What would determine that? Why would you do that? And how do you manage it?
I mean, there's literally a whole chapter of this in the book, so it's not something I'm going to be able to answer in the next 30 seconds. But you know, the inputs would be things like, well, volatility we talked about actually. So if the front contract was very, very low volatility and the second one had high volatility, I'd probably lean towards going out to the second contract. Obviously, there's liquidity, so it depends on the instrument. So in many cases, it's quite a smooth transition from a high volume at the front of the curve to a lower volume later. So then it's a question of pushing out as far along that curve as I dare until the volume drops off too much. For some of the commodities, like, for example, if you look at something like crude oil, then the December contract is very liquid for many years ahead. Right. So that then gives you the option of trading the December quite far out if you want to. Then there's things like also, I really monitor these, but I know sort of from experience that if I look at something like the VIX future, the front contract has very evil skew properties. And the same is true of things like short-term interest rate futures, because if there's a big central bank decision coming up, it's probably going to be 25 basis points or zero, or sometimes 50 or 25 or zero. So it's going to jump potentially in a big discrete units. That makes the price potentially very volatile. The second contract's obviously smoother because it's based on a couple of bank decisions. So that's another input that goes on there. So it's I mean, with 250 contracts, I do actually mostly automate my process of rolling and doing contract selection. There's a little bit of a manual input in there, but otherwise it would be quite a lot of work to sort of every day sit down and decide, well, should I be trading? Is it time to roll to the first of all, the decision is which contract would I prefer to trade, and then having made that decision, you then need to say, well, when am I going to actually roll from one contract to the next? When does that decision happen? As the volume profile changes.
When you roll, do you traditionally trade the spread contract to roll out of the current month?
I do sometimes. So I do the rolling in a number of different ways. The disadvantage of that approach is that there's two issues. One is that it makes your infrastructure more complicated because you need to be set up to trade spread contracts. When I first started trading, I wasn't set up to do that, so it wasn't an option for me. Now I am set up to do that. But having said that, it's not every market where the spread contracts are liquid.
Yeah.
So for example, in interest rate futures, the spread contracts are more liquid than the outrights. But in something like the Korean bonds, there is no spread market really. I mean, there's people showing bids and offers, but they're not. There's no volume behind them. So that's one issue to bear in mind. So what I tend to do now, because I have this, so what I try and do if I can is what I call passive rolling.
Right.
And that means essentially, if on any given day I'm closing an existing position and making my position smaller, I'll close the position I have in the current front month. But if I'm making my position bigger, I'll do that in the next month. So that will mean that I'll naturally be trading out of the first month and into the second month without having to do any additional trading on top of that and incurring extra costs. If I get to the point then that I really do want to roll and I've kind of run out of time, then I've obviously got a number of different options. And one advantage of the dynamic optimization technique that I've described already is that I can actually then say, well, I'm going to close this contract. And what that means is that essentially the optimization will close the contract, and then the next day it will wake up and say, well, is it worth reopening that contract in the next month, having now switched to the next month, or actually is it not really worth doing that? Is it maybe better to we've already got positions on that kind of replicate that exposure? So again, it's helping to minimize the amount of trading I'm doing. So I'm not just slavishly rolling from 1 month to the next. It's actually making a dynamic decision about whether we still need that exposure on, or maybe actually we don't.
Okay, so your roll logic, I mean, is that something that we can keep pretty consistent across all the contracts? Or again, you're looking at 200 contracts, do you ultimately need bespoke rules for different?
Yeah, so what I have is I have a set of parameters I use for each contract, and that will be something like it's basically a preference as to when I'm rolling. So it'll be essentially a single number that says, ideally, I would like to roll X days before expiry. And that's numbers based on on my preference as to which contract I'd ideally like to hold. So if we're looking at monthly expiries, then that number might be 10. If I want to hold the first contract, but if I want to hold the second contract, then that number would be 40, because obviously I want to roll before the second contract becomes the first contract, which will be every 30 days. Once that's then the logic I then use for markets is basically the same in every market, and I have a set of rules that essentially looks at the volume profile between the contract I'm currently holding and the contract I want to get into next. And essentially, as we get closer to my ideal expiry point, and also as that volume starts to switch over, it will basically say, okay, now it's time to start rolling passively. And then it'll get to the point where it says, well, actually, now we need to do something. And at this point, it'll ask for manual intervention. It'll ask me to make a decision saying, basically, do you want to do that spread trade, or do you want to do a kind of double contract roll where you basically close and then immediately reopen in the new contract as two separate trades? Or do you want to close that position and let the optimizer decide whether it needs to reopen? So it'll ask me, to make that decision at that point. But if the passive rolling's already done it for me, or actually, because if you think about it, I've got 250 contracts, I've only got active positions in about 30 of them at any given time. for actually 85% of the time, I don't need to make a decision at all. It'll just say, right, now we're going to roll. We're going to go from using this price to using this price, but we don't actually need to do any trading because I've got no active position on the contract. So that's all an automatic process that happens, and it's only manual intervention is only needed if A, I've still got a position on, and it's quite close to expiry, and the automatic, the passive rolling hasn't already got rid of it for me.
Okay, here's another one. Time of day to execute. So if you're trading end of day models or using end of day data and you're trading markets globally, my initial thinking is I'd like to put in orders once a day, but of course, once a day, which day are we talking about? So are you able to place orders once every 24 hours, or do you have to place orders at the end of cycles of different days around the globe?
Yeah, so this is quite an interesting thing, actually. And I'm doing some consultancy work with a client, and they're sort of obsessed with the idea of getting their live trading to match their backtest as closely as possible, which is fair enough. But that means that obviously using closing data, they're then trying to trade as close as possible to the close of that day. Which is obviously you can't actually do it in practice because the closing price is at the close of the market, right? So in practice, you're going to be trading like half an hour before the close and hoping that the closing price you're getting is pretty close to the actual closing price. The last half an hour before a market closes may not be the best time to trade because liquidity could be very low, or it could be the other situation where liquidity is very high, but there's a lot of crazy stuff going on. I'm not a big fan of that approach. So my approach is to say, well, actually, in theory, in my back test, it says I can trade at the closing price. Okay. But what I do in my back test is to say, well, I'm going to assume that I trade at the close of the following day. So I have a 1 day lag introduced into my back test.
Yeah.
And that, what I then do is compare the performance between the system with and without the lag. And because I'm trading relatively slowly, I should see almost no difference between those two systems. Obviously, there will be small differences every day, but over a 20, 25, 30-year backtest, the difference is tiny. It's very small indeed. And quite a fun thing to do, actually, is to increase that lag and see what happens to your performance and see how fast it degrades. And I'm trading slowly enough that, for example, if the system doesn't run for 2 weeks, that there's still, I'm only losing maybe 10% of my performance on average. So that's quite a nice check to do as well. So that's the back test. The back test assumes we execute the following day's close. So my attitude is, as long as I can execute somewhere between those 2 points, the previous day's close and today's close, I'm happy. So that allows me then to pick a window of time, depending on, as you say, the region I'm trading in, because I'm basically trading broadly in 3 regions. I'm trading in Asia, which trades before I get up in the morning. I'm trading in Europe, which obviously is during the day, and then I'm trading in the US, which is the evening in the UK. So I then basically my system will identify what the liquid hours are for trading a given contract, and then it won't do anything until it gets to that point, and then it will then execute the orders that it sort of has stored from the previous day's closes. And then what I do is I do then a check to make sure that, again, there will be big differences from day to day, but I check on average that the difference between trading at the previous day's close and where I actually traded is not significant. By the way, I factor out slippage because obviously that would make my cost, make it persistently worse. But factoring out slippage, so just comparing mid-price with mid-price, I do a check to see if I'm actually losing anything from that delay between the previous day's close and where I actually execute. Because I know in the back test I'm not losing anything, but I check that in live trading I'm not losing anything either. And once I do that check again, I find that on average over long periods of time that just fluctuates around 0, so that's not a persistent effect. And that makes me comfortable with my approach, because obviously if I was trading in such a way that 1 day lag in the back test made a big difference to my performance, or if the lag in production between the previous day's close and my actual trade was making a big difference in my realized performance, then I would be concerned that I know I'd have to change my approach. But as it is, I design my system so that's not an issue.
So forgive me if I missed the detail there. So you did mention looking for a liquid, a time when the contracts were trading enough volume to be able to execute.
Yeah.
I mean,
Yeah.
and this probably plays into a question about your execution algorithm, if any.
Yeah.
So obviously there's. So are you saying you're almost, is the system always on and waiting for that time, or you've got a few snapshots through the day, or it is just is it a once per day when you've averaged
Yeah,
that
so
there's
in
enough?
practice, I have a process running that I call the stack handler, because I have a stack of orders to execute. And that process runs, and essentially once it sees that a particular, it checks, to see, okay, what orders have I got? Okay, is the market liquid in that order yet? Okay, not. I'll just do nothing. It does other things as well, but I will just do nothing. The moment it sort of moves into that liquid market time, and this, by the way, just to be clear, it's not actually monitoring the liquidity in the market. It's not actually capturing volume. I could do that. It's a complexity I don't think is necessary, but it's basically using what it does is it takes the opening hours of the market, the official opening hours of the market, and I slice off the first and the last hour, because again I think the liquidity is not so great there. So the moment it's so broadly speaking, an hour after the market's open, then it will sort of burst into life and say, right now the US market's open. Okay, what US orders have I got? Right, I'm now going to execute those. And it executes them one at a time, and it uses a simple adaptive algorithm to try and get a good fill price if it can.
Okay, you could use some of the brokers' algos to help out.
Yeah, I could. Yeah, I could use brokers' algos. I've stuck to using my own, to be honest. But it's not a bad algo. It's very, very simple, and it cuts my slippage roughly in half. So which is worth doing. Of course, as a retail trader, a much bigger percentage of your costs comes from commissions rather than slippage. So it's roughly 50-50. So the costs I pay, about half a commission, half a slippage. I can't really reduce those commission costs. Whereas for a big hedge fund, where I used to work, the market impact and the slippage numbers are substantial, and it's worth spending a lot more time trying to reduce them as much as you can. But even if I could get my slippage to zero, I'd still be paying commissions. So there's not a huge amount of value in me spending time trying to optimize my execution a lot more.
Yeah. Okay, a couple more closing questions. So we've touched on one of your favorite subjects, which is crypto. Maybe one of the others is machine learning and AI. So I did just speak to Ernie Chan, and so I have to just raise this. And to be fair to some enlightening comments from Ernie, of course, he spent a long time on that and has been quite frank about the fact that finding any alpha directly through the machine learning approach has not indeed been very productive, but that where he's really making inroads these days is by applying machine learning techniques to his risk management overlays. I think that the question that I've got first and foremost is simply, look, have you given it a crack, and is that where some of your attitudes come from, or are you just sort of monitoring the thing from a distance at the moment and waiting to see some real progress?
I think the first thing to say is that I'm not 100% sure what machine learning is, and different people have different definitions. So you could argue that any kind of optimization that you do on a computer is machine learning, because the machine is learning the parameters for you. And in that sense, I do machine learning, although I do the sort of simpler forms of it. So things like linear regressions and grid searches, and I use some simple clustering algorithms, for example, which are leaning a little bit more into what people think of as machine learning. Now, the principle, well, there's a few reasons actually why I don't then kind of move further down that curve towards, at the end of that would be things like, LLMs and neural networks and very, very sophisticated methods of machine learning. The first is that Ernie is undoubtedly much smarter than I am, and I don't have the sort of educational background or the possibly even the raw intelligence to really fundamentally understand what these things are doing. And for me, that's a problem, because I think one of the dangers of these techniques is that they're being used by people who don't really have a clue how they work. Only they might have a superficial understanding, but not a really detailed understanding. And I'm sure that's not true of Ernie. Definitely not. He's definitely smart enough to understand what he's doing, and the fact that he's been honest with you about shortcomings is a very strong indication of that. But I think there's an awful lot of people out there who think it's just a question of downloading a particular package and analyzing some data and saying, well, now I've got a winning trading strategy. And of course, that's not the case. I think one of the things that I like to be able to do is to really understand where my numbers are coming from. And I think that the more complex the technique is, the harder it is to do that. And of course, we can all see that for ourselves, because if we go into our browser window and open ChatGPT or the new Chinese version DeepSeek or Gemini or whatever, and we ask it a question, and it comes up with an answer, to actually then work out where that answer came from is basically impossible. There's just too many layers of complexity. Whereas if you ask me where any parameter in my trading system comes from, I can tell you, and I can give you an intuitive explanation as to why the number is that and not that. Now, the disadvantage of that approach, of course, is that if there's something really kind of complex and hidden and going on in the market, some kind of latent sort of non-linear effect, then I'm not going to see that. I'm going to miss that. But for me, the dangers of coming up with a strategy that I do not understand, and which is almost certainly has overfitting in its parameters, because that's the other thing. Of the more complex the technique, the harder it is to know whether it's been overfitted or not. For me, the penalties of that, I'm happy to live with the fact that there are things, weird effects going on in the market that I'm not exploiting. I'm happy to let much cleverer people than me analyze those and discover those. And my strong suspicion is that it's interesting that Ernie has found this most productive in risk management, because I think that there's definitely a case that machine learning is working well in certain areas. And one for me, I think, would be execution. So we talked about execution algorithms. For those who are using high frequency data for your optimization, and therefore there's a lot more data and also more likely to be the nonlinear effects. So I think the kind of systematic hedge funds that are using machine learning are probably, that's the sort of main area where it's being used successfully.
So. All right, and one or two final questions. Have you given much time to intraday data and intraday strategies?
Yeah, I mean, I've thought about it. I mean, so one thing I did when I set up my trading system was to take the decision that although I am trading on daily data, as we've discussed at length, I actually capture hourly data. So I now actually have I've got about 10 years worth of hourly data now. And I have played around with some intraday trading strategies, and I've found some that work. I mean, we talked about mean reversion. It's something that works well, I think, at a faster time frequency. My issue is that so the nice thing about a daily trading system is it can be extremely robust in the way it does stuff, because the cost of delay is very small. Like I said, if my trades don't happen for a day, I'm not bothered. A couple of days, 3 days, 4 days. So my system it prioritizes robustness over sort of speed and uptime, if you like. Whereas an intraday system would, from an engineering perspective, is something that you have to be much. The implementation of it is to do it properly in the way so that I'd be comfortable with my own money riding on it. It's quite a lot of work, and I'm not convinced that the other thing to say, of course, is that the dynamic optimization approach I use means that the benefits of intraday strategies would be quite limited. So I'd have to move back to the static set of futures and trade those, and I'd lose some performance from doing that. So net for me, it's probably not something that's worth exploring. But yeah, that doesn't mean to say that it's not something, that there's not something useful there. There definitely is. You just have to keep an eye on your trading costs, because obviously the shorter your time frame is, the higher those costs are going to be. And that means that instead of there being maybe 150 futures that are liquid enough for me to be happy to trade, it's for intraday strategies, it might only be 30, 40 or 50 futures.
Yeah. All right, Rob. I think we've covered a lot of ground, so I really appreciate that. It's been really enlightening. I think it's going to help me. It's going to help others sort of get moving, and working through your book is really like the first step in making this happen. Thanks once again. Do you want to just let the listeners know, a couple of your key sites and contact points? Yeah. Obviously, your blog, and for sure mention the books, because we've raved about them, and they're highly recommended.
Yeah, best thing to do is if you go to systematicmoney.org. From there, there's links to my blog, there's links to all of my books, and there's also links to my Twitter now X feed and my LinkedIn and all of that good stuff, and also a link to GitHub, which hosts the open source version of my trading strategy. So I'm very open and transparent about everything I do. So you can even download the trading strategy I use for trading futures and run it yourself if you have the necessary expertise, of course.
That's awesome. And does GitHub include, you've got your own backtesting engine that you've built in Python, is that right?
That's right, yeah. And you can download that on GitHub. Exactly. Yeah. And it's the backtesting and also the production system. It does both. Yeah.
Fantastic. That's a lot that you've provided to the community, Rob. So again, we really appreciated it. It helps a lot. And mate, we wish you all the best. Hope we can chat again down the track. So thanks once again.
Anytime. It's been great fun, Simon. Thank you again for inviting me, and fingers crossed that all our technical issues will be resolved and the listeners will have a good podcast to listen to.
Indeed. Cheers, Rob.
We should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals, or objectives, so nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.